Recording in progress.
Thank you everyone for joining in today's session. And thank you, Rahul sir, for taking out time and addressing our audience on a Saturday. I'll first start with your introduction for the benefit of our audience. Mr. Rahul Singh is Chief Investment Officer at Tata Asset Management. He has over 27 years of experience in asset management industry. He joined Tata Asset Management in October 2018 as CIO Equities, leading their fund management and equity research teams. In his previous role at Ampersand Capital Investment Advisors, he was the managing partner. He has also worked with financial institutions like Standard Chartered Securities and Citigroup Global Markets India as head of equity research. He is a Bachelor of Technology in Mechanical Engineering from IIT Bombay and an alumnus of IIM Lucknow, where he pursued his Master of Business Administration in Finance. And as an AMC, Tata Mutual Fund is managing more than 1,50,000 crores. So thank you, Rahul sir, for joining in the call and addressing our audience.
Thank you, Aditya. Thank you for inviting me, and I welcome the listeners. Yeah.
Thank you, sir. So, sir, I'll first start with the popular category of mutual funds, which are very relevant in today's market, but not many people are aware about it, because general perception of selecting mutual funds is that people just go by looking at the past returns. And obviously equity funds, if you look at their long-term performance, do fairly well. But people are not very much aware about hybrid funds and what they offer to individual investors. Though as a category, they hybrid funds manage more than 5 lakh crore, but still it's a very, we believe it's an untapped market. So could you explain for the benefit of our audience, what are hybrid mutual funds?
So, Aditya, the hybrid mutual funds, as the name suggests, is a mixture of 2 or 3 different asset classes. So one is the equity, we all know about it, and thanks to all the equity culture, I think everyone is aware of equity, especially in large cities. The second asset category is debt, where you buy fixed income. Fixed deposit is obviously the lower end version of it, but you can buy, debt securities, government securities, corporate bonds, which give you fixed returns, say 7.5 to 8.5, 9% kind of return. And equity can give you between 12 to 15% kind of CAGR returns over, let's say, 3 to 5 year period on a yearly basis. And the third category, which is now also becoming very important, is gold. Right. So you have these 3 asset classes which you can invest through the use of mutual fund. Now, of course, there is a 4th asset class, which is real estate, but mutual funds, you cannot invest through mutual funds. So the hybrid category are funds which invest in equity, debt, and gold, all 3 asset classes in some proportion. So it is not a 100% equity fund. It is not a 100% debt fund. It is not a 100% gold ETF. It is a combination of these 2 or 3 asset classes. I think that is what is important to understand when you talk about hybrid fund. And why it is important is because, while equity tends to give over a long term the best returns, it does not come without any risks. But there could be risk of global risk, risk of COVID, we had a risk of global financial crisis, there could be geopolitical risk. So the returns which you're getting in equity is not without any risk. And therefore, to protect against the volatility in equity returns, the hybrid categories become an important tool to manage the volatility in equity returns while remaining in equities, but still trying to protect the investors from the volatility in equity earnings. So, in technical terms, it is to give you the best risk-adjusted returns, meaning if you can reduce the risk through hybrid fund for an investor and still give him a return which may not be same as equity but slightly lower than equity, that is the objective of hybrid funds. So that, in a nutshell, is what hybrid funds try to achieve and how they are
Absolutely.
designed.
Right. And you used the term risk-adjusted returns. People actually, we have seen the tendency when we deal with individual investors that they always talk about returns, but they never talk about risk. So that is something that people should be aware about on how to improve their risk-adjusted returns. When
Correct.
we talk about hybrid funds, uh, as you rightly said, it is very important to allocate between different asset classes. And we also believe that asset allocation is the major component in determining your long-term returns. And in hybrid funds like balanced advantage fund, you outsource that decision to a professional
Correct.
in terms of asset allocation. So, what are the key things that a fund house like you look at while deciding your asset allocation in your hybrid schemes? You manage close to 15,000 crores across your balanced advantage, equity, hybrid, and multi asset themes. So just wanted to understand your perspective on how do you decide on the asset allocation.
Very good question, actually. And since you mentioned the category which is called the balanced advantage fund and the multi-asset fund, both these categories, what they do is to change the equity allocation depending upon the valuation and the outlook for equity. The idea here is that when the valuations go up for equity, you reduce the equity allocation in this fund. Whereas when the valuations go down, you increase the equity allocation. So basically, it protects you from downside in equities when the market is overheated or overvalued. And at the same time, when the market corrects, it increases the equity allocation to take advantage of that volatility. So just to give you an example, during COVID time, when COVID hit us exactly almost 4 years back, more than 4 years back now, we were at a very low allocation of equity, about 35%. Out of the 100 rupees in balanced advantage fund, only 35 rupees was in equity. And when the market correction happened, this 35 rupees, we took it to 75 rupees in April, May, when the markets corrected. So we not only protected the investors on the downside, but we also took advantage of the downside and increased our equity allocation. So the way the equity allocation and the similar model works in a multi-asset fund also, except that in multi-asset, I also have the opportunity to buy gold, which is not there in balanced advantage fund. So coming back to balanced advantage fund, I think the model which works, which is like you said, the asset allocation is left to a model or left to a professional and not left to the emotional situation of that investor. So what happens is when the markets correct, investors would not put in more money. Instead of putting more money, they panic and they sell whatever equity they have. Whereas we should be putting more money. So a balanced advantage fund takes away the emotion from decision making on asset allocation. So the way we work is that the equity allocation, whether it is 35% or 45 or 55 or 70, 75, 80%, the range is 30 to 80%, is dependent on model of valuation. So we look at the valuation based on the PE ratio of the market and based on some other factors like the momentum and technical factors. We arrive at a score, and that score tells us whether we should be at 35-40% equity allocation or whether we should be at 75-80% equity allocation. So it's a fairly scientific way of determining the equity allocation in the asset allocation, and the remainder allocation goes to either equity arbitrage or debt. So
Right.
that's how the dynamic allocation happens for equity.
Absolutely, sir. And sir, one popular question in everyone's mind is that we have seen a very good equity run up over the last 1 year. Yeah, particularly in the mid and small cap space, both categories have delivered, indices have delivered more than 60 odd percent, while large caps have also performed relatively well, about 25-30% they have run up in the last 1 year. So, how do you look at the current market valuations, and what would be your equity allocation in your balanced advantage scheme?
So the second question, the answer is 45%. Today we are at 45% equity allocation.
Okay.
We can go down to 30%. So we are at the lower end, but we are not the lowest. The
Right.
reason
Right.
being that I think the markets are definitely expensive, but they are not in a bubble zone, because the economy is also doing well. If you look at the
Right.
economy and look at the macro parameters of the economy, whether it is the fiscal deficit, inflation, current account deficit, rupee, it is very, very stable. We have a strong banking sector and a recovery in investment cycle, which is very different from what is happening in other emerging markets. So therefore, our valuations, my view is that we will remain expensive. But we have to be careful that we don't go into an overvalued territory and we don't go into a bubble territory, and which is why balanced advantage fund becomes a very, very, very important fund in the current market, because we are expensive, but another 5-10% rally, we may start looking like a very expensive or a very, very risky market. Right now, I would say that at the current valuations, I can still see a 10 to 12% return over the next 12 months from
Right.
the index, from different. As far as the large cap versus mid cap, small cap decision is concerned, I think the way the market is in terms of the investment cycle recovery and the capex recovery favors mid and small caps and the manufacturing recovery.
Okay.
So from a 3 to 5 year perspective, I think mid and small caps should still continue to outperform the large caps. But if you take a 12 to 18-month view,
Mm-hmm.
I think there is better risk reward in the large caps. So therefore, I would, the response is kind of broken into two time horizons. In the short term, which is 12 to 18 months, I think large caps are looking more reasonably priced as compared to mid and small cap. But if you look at the growth potential over a 5 year period or 3 year period, given whatever changes are happening in the economy,
Right.
I think small and mid cap is a category we cannot ignore. And it has become expensive, but it is not yet to call a market where you need to completely avoid mid and small cap.
Right. Absolutely. And so one important point, as you said, that you are maintaining about 45% in equity, and then remaining in equity arbitrage and debt. And one important benefit that people misses in hybrid fund is about the taxation benefit
Correct.
that it provides. Even on the debt component, you get equity taxation when the fund is maintaining more than 65% gross equity. And particularly for the investors who are lying in higher tax bracket, it makes a lot of sense to have a debt allocation through hybrid funds, because it makes a lot of difference. And people don't understand this equity arbitrage component. And it's, I believe it's also very good category of mutual funds, as well as you take arbitrage exposure in your hybrid scheme as well. So if you could explain a little bit what is equity arbitrage for the benefit of the audience.
Yeah. So equity arbitrage is where you are not taking any let's say long position on equity. You're not buying equity and expecting the prices to go up. What you're doing in arbitrage is purely trying to capture the difference between the cash market and the future market. So let's say
Right.
today, if I buy, say, ABC stock at 100 rupees in cash market, and I short the futures of, say, June at 101 rupees. So I get that 1 rupee spread. So it's completely matched trade. There is no risk of equity volatility in the market. It's
Right.
like a debt product, and in that sense, and that 1% in 1 month I make 100 to 101. If you annualize it, it becomes 12%. Obviously, it's not 12% today that you're making in arbitrage, but
Right.
you're making around 7.5% kind of
Right.
arbitrage, annualized return in arbitrage. And good thing is that this is treated as pure equity fund, the gross exposure, and therefore this is taxed at the equity taxation, and it is treated as a normal equity taxation. Whereas if you compare it with other debt products, who might give you similar returns, but will get taxed at marginal tax or much higher tax, without sometimes without indexation benefit.
Absolutely. It works like a fixed income fund, but offers the benefit of equity taxation.
Correct. Correct.
So, coming from the equity markets, one question that I missed was on the sectoral bets that you as a fund house have taken. If you can throw some lights on the sectors where you are currently overweight on, or sectors where you are currently underweight.
Yeah. So I think the sectors which are doing well and where we are overweight is clearly power, manufacturing, capital goods. And recently, we've also been increasing and becoming more positive on the large private sector banks because the valuations are reasonable, and also pharma. So I would say pharma, healthcare, and banking are the new sectors where we think that there could be upside from a 12 to 18 month perspective. And the rest of the sectors, as I mentioned, are in a 3 to 5 year upcycle, which is manufacturing, power, capital goods. So there we continue to be positive. Of course, the valuation, we always need to be disciplined on valuations, and therefore some of those stocks have done very well. But good thing about Indian market is that we are a very diversified set of sectors. So there is alpha look for outperformance somewhere else. As far as the sectors where which are not doing well, or where we think that there could be a some more period of uncertainty, clearly IT services is in that bucket where there could be a little bit of a continued uncertainty on global spending on IT. And the second sector where things have not been very good is consumer. But I think of late we are also seeing that some parts of the consumer sector have started reviving. So I would be less bearish on consumer. But IT definitely we need to be in a wait and watch mode at this stage.
The fixed income markets, how are you currently looking at the fixed income market scenario, looking at this flattish yield curve? Should one be looking to lock in higher yields for long duration, or considering the interest rate cut cycle? So how do you look at this scenario?
Yeah, that is definitely. I mean, I don't look at personally myself. I don't manage the fixed income part. But
Right.
if I were to give you a short response to that, yes, that is definitely what we are recommending. We have been recommending for some time to lock in into these returns at medium to longer duration papers. And that is what we have been doing. So even in balanced advantage fund, for example, or multi-asset fund, the debt portion, this is the logic we are applying even to the debt portion of the balanced advantage funds.
Right, right. And now, sir, I'll come to a very popular question about elections. So, election results are just underway, and everyone talks about the strategy before and after elections. So, how do you, as a leading fund house, see this event? And does your strategies or sector allocation change based on this event?
Aditya, I think it is very difficult to predict elections in India, as we all know.
Right.
And I think the first data point we'll wait and see is what happens in the exit polls. Obviously, the markets are not factoring in any negative surprise. Now, plus minus can happen, but no major negative surprise is being factored in or thought about. So therefore, your guess is as good as mine as to what will happen on that day. What we do, therefore, is that it depends on what happens in the next 10, 12 days. And if the markets continue to rally there, like they have been rallying, we will probably build some risk protection in our portfolios. Whereas if the markets remain like this, we may not have to do much. Also, it depends from fund to fund. So, for example, in a balanced advantage fund, the risk protection will happen automatically. If the market rallies tomorrow further, let's say 5%, hypothetically, my balanced advantage fund model will automatically shift me down from 45% to 40% or 35% equity, right? So to that extent, there will be an automatic protection which will happen in balanced advantage fund. In a diversified equity fund, depending on what the valuation is and what is the risk profile of that fund, I also sometimes take some decisions which can protect us from a black swan kind of an event on that day. But there is only so much you can do. End of the day, this is a risk which is difficult to difficult to predict.
Uh, so, sorry, my network went off about the elections.
Okay.
So,
Okay.
just
Good.
hello.
Yeah.
Yeah. So, just one last question that we have as a wealth manager, we constantly are thinking about asset allocation and understanding the risk profile of our customer. And as a seasoned professional with more than 27 years of experience in equity markets, how do you decide your personal asset allocation? What are the key principles that you use while deciding that?
So my personal allocation follows what I have also been advising for some time, that I think for an average investor and for someone who's approaching my age, especially 40% should be in the hybrid category, mostly balanced advantage fund and the hybrid funds. And I manage my debt allocation through this category only. Another 35-40% can be in the diversified equity category, whether it's large and mid cap or multi cap, or even a value fund. We have a very good value fund, Equity P, which has got a very good track record. And the last 20% can be in high risk categories, which can be a combination of sectors. It could be a combination of banking and pharma, or it could be a combination of infrastructure and pharma. And I would put small cap also in this category. So I would say small cap, banking, and pharma is a good combination for the last 20-25%, where we need to take risk, because this is a market where we need to be cautious, but we don't need to be overcautious. So therefore, this 40 or 50% in hybrid takes care of the cautious part, but the remaining 50-60%, we need to be also aggressive and take some risks to get returns, because as I mentioned some time back, the economy is also doing very well. So this is not the time to be very, very risk averse also.
Absolutely, absolutely. So just the last part, we would everyone knows about Tata Mutual Fund. You manage more than 1 lakh 50 1,000 crores. You can throw some light.
Yeah, so we follow growth at reasonable price as a strategy. And what growth at reasonable price means is that it is not high growth, high quality, high P companies. At the same time, we don't buy value stocks for the sake of value. I think both strategies do not work in Indian context because India is a growth market. So what we look at is that while remaining disciplined on valuation, how do we identify companies which can surprise on growth and available at reasonable valuation today? I think that is our entire effort. And when we construct our portfolios, we keep different proportions of growth at reasonable price. So a very aggressive fund like business cycle fund will or equity PE fund will have 80-90% under GARP and only 10-20% stable compounding kind of companies. Whereas if you look at a large cap or a balanced advantage fund equity portion, that proportion will be more like 50-50. That you'll have 50% GARP stocks and 50% stocks from benchmark or a steady compounding kind of stocks. So that is our entire approach. As far as team is concerned, we have a very stable and experienced team. We have, apart from me, we have 4 senior fund managers. We also have 4 very senior analysts who have also become fund managers of their respective sector funds as well as diversified funds. And then we have 4 pure analysts or analysts who are only covering sectors right now. So as you can see, we've got a good bench and we've got a good kind of layers of talent which we have been um, cultivating, and also some of this help as and when the growth happens in the either in the AMC or in the market, or even when the analyst is ready to become a fund manager, he is able to become the fund manager. So therefore, we've got a good kind of, I would say, structure to manage our team.
Right. Thank you so much, sir, for taking out time. I'm sure our audience is much richer in their knowledge with the. Thank you so much for taking out time and your team.
Thank you, Aditya. Thank you for hosting me, and it was my pleasure also. And I hope your viewers find it useful, especially in this time when I think asset allocation is a topic which not many people or hybrid funds, not many people are discussing.
Right.
But I think it's a right thing to focus on at this stage to manage the risk and still make the returns which you want to make the returns.
Thank you so much, sir. Thank you.
Thank you very much.